Silver price. Silver's over $100 per ounce. It was $115 per ounce earlier today. It's been on a tear since late 2025. The silver price up about 170% in 2025.
Hey everyone, welcome back to the channel. So I came across this interview from the Vancouver Resource Investment Conference that I need to break down for you because the numbers being discussed here are absolutely wild. Ian Harris, the CEO of Outcrop Silver, is sitting down with Kitco Mining and casually dropping a claim that silver surged 1,770% in 2025. And he's explaining exactly how that kind of explosive move is creating opportunities in mining equities that even legendary investors like Rick Rule are rotating into. This is one of those conversations where the implications go way deeper than the surface level price talk. Make sure you stick around through the entire breakdown because the third section covers something really important about supply constraints in the primary silver development space that most people aren't paying attention to. And real quick before we jump in, drop a comment and let me know where you're tuning in from today. I love seeing where everyone in this community is located. All right, let's get into it.
What a great time to be a silver explorer. Hello and welcome to Kitco Mining's Investment Trends with me, Paul Harris, here in person at the 2026 Vancouver Resource Investment Conference. Joining me today is Ian Harris, Chief Executive Officer of Outcrop Silver, which trades on the TSXV under the ticker OCG. Ian, welcome to Kitco.
Believe it or not, we're not on the V anymore. We've fully gone to the TSX. Same sticker, but we have now gone to we put our big boy pants on.
Excellent, congratulations. And big boy pants on, we got a big boy silver price. Silver's over $100 per ounce. It was $115 per ounce earlier today. It's been on a tear since late 2025. The silver price up about 170% in 2025. What has been the impact of this big push in the silver price on silver explorers and developers such as yourself?
Obviously, it's changed how we operate from day and night, right? The asset doesn't change. The valuation obviously changes. I talk a lot about putting the big boy pants on, but I know there's a lot of people who have understood the narrative of silver waiting a decade for this kind of thing to happen. But obviously, in our year, we're highly financed, so we have the capital. Something I said I haven't had in 12 years is I have 2 years of runway. That is just, mind-boggling. So this year for us is about execution. It's about bringing in some institutions. Our year plans we accomplished in 2 months, right? Be able to bring in the strong institutions, raise the capital, have a long runway, and execute on a plan. So it's really given us the ability to execute on what we've always wanted to execute on.
Okay. Now, in 2025, Eric Sprott invested another $5 million into the company, and you brought in Jupiter Asset Management. They came in for $15 million,
correct,
if I remember. Having that 2 years runway, how important is that? I mean, obviously, you can focus on the technical aspects without the distraction of always being out shaking the can. How important is it having that 2 years of runway?
Shockingly, it didn't dramatically change the strategy because there was always a value path. I wanted a value path that would create value even if silver continued to go sideways. Obviously, highly leveraged to silver price. But what it's allowed us to is to be able to accelerate and to be able to execute on it with a whole lot more confidence. For example, last year at the same time, I think we had 2 drills running. Today, we have 4 drills running. The ability to take the jump. We were at 37 million ounces. We're going to be putting out a new resource soon. I wanted to make a big jump, and then the next goal would be to get somewhere closer to 100. But now it's the ability to not take 2 years to do that, but maybe be able to accomplish that within the following year. So being able to accelerate those programs, and then obviously a more focus on converting it from just a resource and our valuation based on a resource. Santa Ana has the advantage that it's a really strong project. Grade equates to economics. So being able to think, how do you get this thing into production? So our goals now is to very soon be putting up the updated resource. The next resource should include, we're now thinking, definitely will be including a PEA in the next version because now we have the firepower to be able to deliver, and then looking at getting things towards production. So it's been very empowering, right? It gives you a much more solid base to be able to execute on.
And shrinking those timelines on to hit your goals. We're talking about the Santa Ana project in Tolima in Colombia, where you kindly hosted me on a site visit in late 2024. With the PEA update that's coming, how will that look like compared to the original PEA? Are there going to be any changes in there, any things that are different?
So to be clear, we will be pitting it within the next month time frames, be putting an updated resource. And then looking a year into the future, the next resource update would include a PEA. The project has never had a PEA. So this is the first time you'll be able to see economics. But obviously we're excited about that because I call about the trifecta. You have primary silver, you have very high grade, you have very good recoveries, and it produces a precious metal concentrate or doré, so a very simplified flow sheet. That all really comes to glow and to shine when you start putting the economics around a project. So we're very excited that we'll be able to deliver on that, and with a high level of confidence, we'll be able to deliver on doing that in the next year period, because you don't have the can out anymore. So it's really about execution. I put out a CEO letter and I talked to her. This is the year of execution, right? We spent the time saying this can grow. We proved it can grow. Now it is demonstrating that the numbers are going to come out at the end of it. So it's very exciting for us.
Okay, so right off the bat, we need to talk about this number because when Paul Harris said this, silver's over $100 per ounce. It was at $115 per ounce earlier today. It's been on a tear since late 2025. The silver price up about 1,770% in 2025. That is the kind of move that changes everything for exploration companies. Now, whether this is a hypothetical scenario or forward projection, the mechanics of what Ian Harris is describing here are absolutely critical to understand. Because when you have a 1,770% move in the underlying commodity, the standard beta relationship between metal price and equity performance completely breaks down. And Ian just confirmed this when he said this, I have 2 years of runway that is just, mind-boggling. 2 years of fully funded operations. Do you understand how rare that is in the junior mining space? Most exploration companies are in constant capital raise mode, perpetually diluting shareholders just to keep the lights on. But when you have Eric Sprott dropping another $5 million and Jupiter Asset Management coming in for $15 million, that is institutional validation at the highest level. And here's what most people miss about that runway. It's not just about survival. It's about execution speed. Ian literally said this. Our year plans we accomplished in 2 months, right? When you compress timelines like that because you're not fundraising every quarter, you can move from 2 drills to 4 drills overnight. He mentioned this last year at the same time. I think we had 2 drills running. Today, we have 4 drills running. That drilling acceleration is how you go from 37 million ounces to potentially 100 million ounces in a condensed time frame, and that is how you create the scale that matters for institutional acquisition targets.
Now, on the site visit, we spoke about how the thumbs up rule of thumb, you're looking to get to that 100 million ounces a year because that theoretically is a 10-year mine life at 10 million ounces a year of production. To what extent does that sort of potential thesis still hold true for Santa Ana? What sort of scope and scale are you potentially looking at?
So it's still a very important rule. It's a psychological number, getting to that 100 million ounce number. I don't know if we'll get there by the PEA, but we'll be getting close, and obviously know that we have time because as you go from PEA to PFS. The goal is if you're close enough, you're going to get, the project doesn't change dramatically if you increase the resource by 20%. Right now we're talking about 50, 60, 70% increases in resource, which have a huge impact on the valuation of the company. But when you think about 10 million ounces and you're 70+% silver, that's 7 million ounces a year of silver. That's a significant player within the industry, right? You're in a top 25 size producer for silver, even at that size. So it's enough and important enough because scale still matters, right? When you look at companies looking at acquisitions or mergers or amalgamations, they want something that's worth their time. So that becomes now something worth their time. Could you imagine 10 million ounces a year, 7 million ounces of silver to anybody's balance sheet? That would make a significant impact and maintain the silver lining, right? Which is also very important. A lot of companies have gone from being a primary silver producer to then a gold producer to a lead zinc producer, and really have transformed over time because they couldn't get the scale. So having something out there with scale obviously makes it very desirable.
Silver's $100 per ounce, but I think it would be fair to say a lot of that valuation, a lot of that value isn't necessarily reflected in the valuations of junior explorers and developers such yourself. A reference point there is perhaps, may or may not be a good reference point, but we've seen Highlander Silver announce the taking over Bear Creek mining in Peru to get the Corani deposit. That was announced in December. Corani is a big deposit. When you work out the price per ounce for reserves, it was something like 60 to 80 cents. So that could be a very specific example and not a relevant comparison. But how do you get that silver price value reflected into the value of your asset?
So we watch this very closely. Dollars per ounce in the ground. What's our valuation at? What kind of beta do we trade at? I mean, because the compelling reason to invest in a silver explorer is if you believe in silver, we normally trade to a beta to silver price. And we were normally over 2 or 3 years about a 2-to-1 beta, but it is broken down as silver has gone hyperbolic. But I think that eventually things catch up. I mean, one of a big takeaway for me here even was hearing Rick Rule say, I've sold all my physical silver because now there's more leverage because the silver miners have not caught up. For some reasons, when you talk about reserve pricing or a PEA pricing or even guidance, it's based on a much lower price. So once that guidance hits market, there's an expectation of a serious re-rating. So we have not caught up to, as the parabolic move in silver price, we have not moved parabolically as a group, right? But the expectation is obviously that creates value, right? So there should be a value right now for people who are looking to, okay, I made a lot of money on silver, where can I rotate? And Rick Rule is a prime example of that, where he's saying, I can now believe I'll make more money in the silver miners and explorers than I will on the actual physical silver.
Now this is where the production scale thesis gets really interesting when Ian talks about targeting that psychological 100 million ounce resource number. He's laying out the blueprint for becoming a significant primary silver producer. And he said this, 7 million ounces a year of silver. That's a significant player within the industry. Let me put that in perspective for you. 7 million ounces annually puts you in the top 25 global silver producers. That is not a small-scale operation. That is the kind of production profile that major mining companies pay serious premiums for in M&A transactions. But here's the part that absolutely validates the re-rating thesis we're seeing play out. Rick Rule, one of the most legendary resource investors of the past 40 years, made a statement that should make every precious metals investor sit up and pay attention. Ian quoted him saying this, I've sold all my physical silver because now there's more leverage because the silver miners have not caught up for some reasons. Rick Rule sold his physical silver position to rotate into mining equities. Think about that strategic shift. And then he explained exactly why. When you talk about reserve pricing or PA pricing or even guidance, it's based on a much lower price. So once that guidance hits market, there's an expectation of a serious re-rating. This is the valuation arbitrage opportunity. When preliminary economic assessments are still using $30 or $40 silver assumptions, but the spot market is trading at $100. There is massive embedded value that hasn't been reflected in equity prices yet. And that re-rating catalyst comes when updated studies hit the market with revised economics. That is the leverage multiplier Rick Rule is positioning for.
As you have a sort of resource update, as you're planning that and getting closer to that later this year and then onwards for PEA, what's your thought on the sort of the pricing, the benchmark pricing you're going to use in that? Because consensus pricing is what, $20, $30 per ounce. So at those levels, you're very much undervaluing the asset in a $100 per ounce price environment. How do you sort of thread that needle?
So shockingly, first of all, on the updated resource, it really, and that's something people need to understand, is that when you see the prices used in a resource, it's only to calculate ratios. It really doesn't have a big impact. Actually, we did the exercise of looking at cutoff, because at higher prices, your cutoff goes down. But because we're in veins, it literally changed, doubling the silver price changed our whole resource by 10,000 ounces, right? So most of the veins are above cutoff anyways. But when you go into a PEA, then you normally aren't at the consensus price yet. You're normally looking at a 2-year or 3-year trailing average. And shockingly, the 2-year trailing average is way higher than it's been in a very long time. You are pushing the high 30s to $40 per ounce range. So it's already starting to price in, but obviously even $40 is nowhere close to where actually are today. And I think that's one of the compelling reasons of why people like these types of opportunities, because they see as you get closer to a production decision, there's a lot of value still left on the table. It's a whole lot better than when you have a $40 silver price or whatever metal price, but the real price on the street is $20 when you're going the opposite direction. And so that's a lot of the upside. And that's how mines get built. That's why we're in a secular business, because it takes a while to get these things into production. When they finally hit the market, it could take 10 years, and that's why these cycles have a tendency to run for a very long period of time and reward those that are ahead of the curve. And that's one of the advantages that we've had, because we've been able to deliver even in a more difficult market. Now that we're in a much better market, it allows us to, cosecha, bring in those fruits.
How do you see the competitive landscape evolving? Going back a couple of years, there was quite a bit of high-profile M&A with mines being built. As I mentioned a moment ago, Highland is building a development stage asset. Do you see M&A coming down into the sort of more development stage companies such as Outcrop? Do you see that getting more competitive and more bids coming in for companies and assets such as yours?
So I remember a presentation by Sean Kunku, and I can't remember where I was, but it was, within last 6 months. And he goes, last year there was 10 opportunities. Today there's 7 opportunities. There's a very small group of actually quality high primary silver projects. And now he's kind of off the list, right? So
yeah, it's been Dolivard and Silver's been taken by Contango ore. Yeah,
correct. So there's the list is very short. Now, the issue that you see in silver is that it's hard to develop size and scale. So you see a lot of silver guys become gold guys or become, more lead and zinc, and their percentage of overall silver becomes lower to get that scale. So it was cool or interesting about the silver space. It's not just the acquisitions by producers. Today, they've more looked at producing assets, but there's only so many, right? The list is short. So I think, yes, it will eventually come down the list. But another highly likely scenario is what built the great mid-tiers over the last 20 years was amalgamation, right? So staying together, they'll either huddle, or that's the other reason why we talked about.
So let's talk about how these economic studies actually get priced, because this is where the technical methodology creates that valuation gap. Ian explained that when companies publish PEAs, they're not using current spot prices. They're typically using a 2 or 3 year trailing average. And he said this, the 2-year trailing average is way higher than it's been in a very long time. You are pushing the 30 to high 30s to $40 per ounce range. So even with a trailing average that's elevated historically, you're still looking at $40 silver assumptions in a $100 spot environment. That $60 per ounce delta is pure upside that doesn't get captured in the initial economic models. Now here's the supply side constraint that makes this even more compelling, where Ian referenced a presentation by Sean Kungu where he said this, last year there was 10 opportunities. Today there's 7 opportunities. There's a very small group of actually quality high primary silver projects. The number of institutional-grade primary silver development projects is shrinking, and one of those 7 just got taken out when he mentioned silver has been taken by Contango War. Referring to Contango's acquisition, So you're down to 6 quality primary silver assets in the development pipeline globally. 6. When you have tightening supply of development stage assets and you have producers looking to replace depleting reserves and grow production profiles, that creates M&A premium compression. And what Ian's describing with the 100 million ounce threshold is specifically about becoming large enough to matter to a senior producer's balance sheet. Because if you can deliver 7 million ounces of annual primary silver production, you're maintaining that precious metals focus instead of becoming a base metals producer with silver byproduct credits. That distinction matters enormously for companies trying to maintain silver exposure in their portfolios. So what do you guys think of this? Leave your thoughts down in the comments. Please like and subscribe, and I will see you in the next video.